and I'm talking about the 5 factors to measure a country's investment risk level from The Economist. My name is May Doldalal. My blog is yesfinanciallyfree.com. So at any time, go to yesfinanciallyfree.com. I'm actually broadcasting live right now if you're on my live. If you're watching the replay is on the blog with a written description of what I'm talking about and more information. And if you haven't gone to my blog, I highly recommend you do, because you can put in your first name and email address on the right side if you're on a computer. Just scroll down if you're on a phone and hit the big red yes button to get the free ebook, Working Parents Guide to Financial Freedom, sent directly to your inbox. And you'll get on my email list. And that's when I tell people when I'll be live and talk about the topics that I'm discussing. And I give you direct links to all the blog posts and any bonuses that I have. So it's a great list. I do a live once a week. So I encourage you to do that. Now, let me tell you about myself. I live in Honolulu, Hawaii. So this is a condo that my husband and I own in Waikiki, and it's a couple blocks from the beach. And then we own another condo down the street, also in Waikiki, which is an Airbnb business. But back in 2011, I owned no property, had never owned property, and I was in I think it was over $40,000 of credit card debts, personal line of credit debts, about 8 or 9 or 10. I don't remember exactly right now, but there were a lot. Okay. And it was from overspending. Now I finally stopped overspending, and I started doing techniques that were taught to me to improve my finances and to create financial freedom. And by 2016, I had paid off all my personal debt, and I had improved our family's net worth by $500,000. I was making almost $500 a month in passive income, which are mostly from dividend yielding stocks. And I quit my job. So December 23rd, 2016 was my last day. And I still remember when it was fresh, okay? When I just quit and I was like, oh my gosh, yeah. I started coaching clients to do what I did, which is to focus on creating passive income, not paying off debt, okay? Focus on creating passive income. Focus on financial freedom, and that you can pay off your debt at the same time. But your focus is on creating a better lifestyle. So I've never gone back. I haven't had a job since that I didn't create, okay? I do work for myself and my husband. We have our own businesses, right? We have an Airbnb business, which I already mentioned, yeah? This coaching business as well, and the blog that I'm doing, I also have investments that I'm constantly working on. So that I wanted to tell you is a story about who I am. I am someone who made bad decisions. Okay, so I understand what it's like to overspend, get into a lot of debt, have a lot of high interest credit cards. I understand how it is to get out of debt and to create wealth and to increase your lifestyle and your standard of living. Okay. I used to live in a much lower standard of living. Now I live in nicer places, nicer condo, nicer environments. Even the sound level outside is like quiet. Okay, I just shared that to give you hope and to let you know that I'm here to help you. Okay, and you can do it. I did it. You can do it. You have the ability to do this. All right, it doesn't matter who you are, what level you are at. You can do this. So let's talk about today's topic. Now, why am I talking about 5 factors to measure a country's investment risk from The Economist? Recently, I've been studying how to diversify our portfolio beyond the United States. I want to invest in other countries, and this is advice from Ray Dalio. He's been on different interviews. My blog post last week talked about he's had 2 interviews of him in it, so you can go check that out. But he basically says cash is trash. You need to diversify. You need to invest globally. And then when he said globally, I was like, well, I'm not invested globally per se. So I'm like, okay, I got to learn more about this. And basically, what he said was you have to look at a country the way you look at a person and any business. Okay, so how do you do that in a country? So I started researching that, and that's what I came up with this blog today. And I found out that The Economist, which is a magazine that studies, economists studies the economy and business and finance and all kinds of things like that, commerce. They have a whole research unit dedicated to assessing risk level of countries, among other things. And people pay, so you can actually pay for their subscription service. to get their risk assessments. So this is from The Economist. I just got Schwab, which is an online trading platform, a brokerage company, which is free to join. You can open a free brokerage account. They have free trades for, free stock trading. Yeah. And you can actually get access to what I'm talking about in Schwab. So they I guess are subscribing to The Economist to get their research and sharing it with their members. So, but I just have their report from The Economist, and it just talks about how they tell if a country is risky or not. So I'm going to share that with you, the 5 factors that they use. And then if you feel like, getting a free account at Schwab or going and checking out The Economist Intelligence Unit, that's what they're called, you can go ahead and do that. So I thought it was fascinating, so I'm going to share it with you. These are the 5 factors, okay? So the first thing they look at is the sovereign risk measure. Sovereign risk, okay? Who's in charge of the company, country? So we're looking at countries, not companies, but we're looking in the same situation. So who basically is the president, which is like looking at who is the CEO. Who's the management? Who is running this country, right? So sovereign risk measures the risk of a buildup in arrears of principal add or interest on foreign and or local currency debt that is direct obligation of the sovereign or guaranteed by the sovereign. So the country, all right, are they likely to pay back any debts they have, okay? Are they going to pay back the principal and interest, or are they going to not be able to pay it back? All right, so they're trying to figure out, is the country good for the money? Okay, so that's the sovereign risk, all right? Are they good for the money to foreign countries, foreign entities? And are they good for the money inside their own country, right? Do they owe money to someone in their own country, like a business magnate, or somebody is investing from inside their country? Do they pay them back, right? Do their own citizens who buy bonds, like us, buying U.S. Treasury bonds, does the U.S. government pay our Treasury bonds back, right? Does that make sense? Yeah. Now, if the government is good for it, they get a better rating. Yeah, you guys get it. So that's the sovereign risk. That's their first measure. All right. How do they measure that? Well, they probably check and see, are the people, in the United States, when you get a bond, are you getting paid back, right? What is the likelihood that you will continue being paid back, right? You can kind of get an idea of how they figure it out. Obviously, if they're not getting paid back, that's a big measure, right? Okay, currency risk measures the risk of devaluation against the reference currency. Usually they use the US dollar as the reference currency, but sometimes they use the euro as the reference currency, of 25% or more in nominal terms over the next 12-month period. So they're trying to see the value of the currency. Is it fluctuating a lot in value? Is it expected to fluctuate a lot in value? Is it going to go up or down? Actually, they're just looking at down. Yeah. Is it likely to go down more than 25% in the next year? Okay. How strong is the currency? All right. Now, you can tell that in a number of ways. The most obvious way is if the country gets out of control in money printing, out of control, just printing it without any plan, to abandon. And I've had friends who I met on Periscope from other countries who have told me that their country's currency got devalued and it caused massive chaos for the economy. So it happens. All right, you got to be careful of that. Next factor, number 3, banking sector risk. Gauges the risk of a systematic crisis whereby banks holding 10% or more of total bank assets become insolvent and unstable to discharge their obligations to depositors and or creditors. So they're trying to see, are banks good for the money, right? If you put money in the bank, can you get it back out, right? Are banks keeping their promises? Is 10% or more of the banks going to be insolvent, going to go out of business and not keep their promises? All right, so that is the banking sector risk. Now this, when I lived in Taiwan, I lived in Taiwan in the late 1990s, early 2000s. There was a huge influx of Indonesian immigrants because their country's banking, and one girl I knew in particular used to work at a bank. She used to work at a bank in Indonesia, and the bank went insolvent, right? It got shut down. I don't remember if it was insolvent or the government did something. I don't remember exactly, but the bank shut down. No more bank, right? And so she left the country, right? Because you couldn't get a job there anymore. So this is a very real thing that happens. Okay, so banking sector. All right, next one, number 4. Political risk evaluates a range of political factors relating to political stability and effectiveness that could affect a country's ability and or commitment to service its debt obligations and, of course, or cause turbulence in the foreign exchange market. This rating informs the first 3. So political risk affects banking risk. Like I said, if you get some kind of a leader in the country who just hates banks and just shuts them down or raids them or whatever, right? That's obviously a banking risk, and that's a political factor. So whoever is in charge of the country, and I talked about that in the top at sovereign risk, but I was mistaken. So sovereign risk means, is the country going to pay back its debts? Political risk is who's running the country. Okay. So political risk, who is in charge of this country? Are they people of integrity, right? Are they dictators greedy dictators who are just going to ravage the country and then let it, kind of like destroy itself? Or are they people who are future-minded, present-minded? Are they compassionate? Are they there to help the economy grow? Are they there to grow businesses? Are they there to sustain the environment, to make things happen in a way that everyone can thrive and be at peace? So whoever's running the show. So that's number 4. I talked about that before. I was mistaken. So that's the political risk, but that is also very important. Last one is economic structure risk. Is derived from a series of macroeconomic variables of a structural rather than a cyclical nature. Consequently, the rating for economic structure risk will tend to be relatively stable, evolving in line with structural changes in the economy. And this rating will inform the first 3. So economic structure risk, and they make it sound very obtuse. Like, what are they talking about? Series of macroeconomic variables of a structural rather than cyclical nature. So they're looking at what the economy, we know economy is buying and selling, right? You have something worthy of being sold. Someone wants to buy it from you, right? My son and I were looking at countries yesterday, and he's just picking countries. Like, he's just looking at this list, and he's like, I want to do Q, and there's only one country there, Qatar, okay? I don't know anything about Qatar except that it's in the Middle East. So we do Qatar, and I find out that they are, at the time, the biggest supplier of natural gas in the world. And they have a video of this natural gas platform that they created to get natural gas from underneath the Persian Gulf. So you could say that Qatar economic structure, they have natural gas as one of their resources, one of the business elements, the economy. A lot of it is getting wealth from natural gas, all right, petroleum products, natural gas. And they have enough to export and sell to other countries. Yeah. And so this creates and I'm assuming that's what they mean by economic structure, like the businesses that are in that country and buying and selling what is being bought, what is being produced, what is being sold, right? Are they importing consumer goods? It said that Qatar had to import agricultural products because they couldn't grow enough food for their population. At least that's what I read when I was looking at. By the way, I got this whole list of countries with my son that we were looking at from the Census Bureau, the U.S. Census Bureau. They have a website where you can look at countries. And that's very interesting because they're looking at trade balance. But anyway. those are the 5 factors that the Economist uses to rate whether a country, what their risk rating is. Like, are they risky to invest in, not risky to invest in? Okay, and the Economist, they use like an AAA down to a D. A D is the worst that you can get, okay? An AAA is the best. So this is the Economist, and they use those 5 factors to give grades, all right? Now, beyond how that is done, that's within their own unit, okay? But they're just kind of telling you the framework that they use. Now, AAA means they have the capacity and commitment to honor obligations not in question under any foreseeable circumstances. So that means that you lend them money, they'll pay you back with interest. They're good for it, all right? That's what it means, okay? Now, a D rating is very weak. Capacity to commitment to honor obligations, poor payment record, currently in default on significant amounts. So you lent them money, they're not paying you back. It's like that relative that always wants money and never pays you back, okay? So you can look at countries like people, you can look at countries like companies and rate them, and this is how the Economist does it. So those are 5 ways to measure a country's investment risk level. And so they go country by country and they give them grades based on these 5 factors. So I hope you enjoyed this live video today. I'm going to edit my blog right now and put in more detail what I'm talking about. But I'm really grateful to have you here. Subscribe to the YouTube channel if you haven't done so already. Appreciate it. And if you're Instagram, thank you so much. Click on the link in my profile. Check out yesfinanciallyfree.com. Share this with your friends and followers. And I will be here again next week, same time, with another great topic. Aloha. Take care.